Hello, and welcome to Middle East Focus, a weekly podcast on regional affairs and U.S. policy, produced by the Middle East Institute in Washington, D.C. I'm Alistair Taylor, MEI's editor-in-chief.
And I'm Matthew Czekaj, managing editor at MEI.
From Gaza to Iran, the Middle East is experiencing a period of sustained conflict, with rippled effects spreading across the region. What impact has this had on the outlook for the Gulf states, the region's leading economic actors? How is it affecting energy markets, and what might it mean for Gulf investment plans at home and abroad? And how are policy moves in Washington affecting economic relations with the United States, following President Donald Trump's widely publicized trip to the Gulf earlier this spring? To discuss these issues and more, we're joined today by Karen Young. Karen is a senior fellow at the Middle East Institute, where she leads the Economics and Energy Initiative. She's also a senior research scholar at the Columbia University Center on Global Energy Policy.
Our listeners can subscribe to Middle East Focus on Spotify, Apple Podcasts, and other podcast providers. And please check out MEI's other podcasts, Rethinking Democracy, hosted by Gundul Toll, and Taking the Edge Off the Middle East with Brian Katulis. So Karen, welcome to the Middle East Focus. It's great to have you on the program.
Thank you so much for inviting me. Good to be with you.
So half of 2025 is behind us. It's been a very eventful year so far. Where do things stand with the Gulf Cooperation Council members? The Gulf Cooperation Council being the Arab monarchies in the Gulf. What is the overview for the macroeconomic environment?
Yeah, well, thank you, Matt. This is certainly a very trying time globally. Trying to anticipate where certainly where energy markets are going, but also the kind of surrounding atmosphere of trade tensions and really uncertainty. So much around conflict in the region, but also on kind of the broader geo-economic sort of scale of things. But the Gulf states are weathering this pretty well, I think we could argue. And there's been a recent report the World Bank did their GCC macroeconomic report just this month. And it looks pretty good. So even though 2024, we saw a pretty significant contraction in the hydrocarbon sector in the Gulf, what's been good news is that the non-oil sector across the GCC is growing at about 3.9%. And that was for 2024. And we're looking at, around 3% growth for 2025, and maybe a little bit more projected in 2026, about 4.5%. So that's a pretty good indicator when we keep in mind still how dependent these economies are on hydrocarbon revenues, particularly for state spending. But the non-oil economy is doing better. The other thing that is interesting about Gulf economies compared to the wider Middle East region is that they have been less vulnerable to inflation. So inflation has been pretty steady, really and low. I mean, lower than even in some U.S. rates, about 2%. And what we're seeing is that there have been deficits in fiscal accounts, also in current accounts. But right now, just 3 of the 6 GCC states are running these fiscal deficits. And that we see somewhat pronounced in Saudi Arabia, very much in Bahrain, and a little bit in Kuwait. So there's always going to be a pretty important differentiation between the GCC states. So we think of them as a block, but these are economies that are actually really quite different now in terms of their capacity, certainly for attracting foreign investment, but also for their ability to grow and to generate revenues. But not just from hydrocarbons, but from other sectors, new sectors in manufacturing, technology, tourism, etc. The other point of differentiation, which I think is interesting, is the way these states are thinking about tax. So we've had the rollout of the value-added tax over the last few years, first in the UAE and Saudi Arabia, now a bit more broadly. And countries thinking about, what are alternate sources of government revenue? So you can do this in a lot of ways. You can create fees, you can create tolls on roads, and sort of the taboo has been this idea of personal income tax. And Oman has been the first to basically put a stake in the ground and say, we're going to do this. We're proposing the idea. We're putting it a little bit further down the road, a couple of years from now, to roll out. a pretty low tax rate as proposed, and it would only affect people who are making over about $100,000 a year, and it would be on residents as well as citizens. So that's a really interesting kind of way to think about your demographics, about who's responsible for generating government revenue, and who is then a recipient of the services that a state can provide. So we're going to be watching that space really closely. What happens in the GCC is that we often see this policy diffusion process. This has certainly been true since 2015, 2016, when a wave of economic diversification reforms have rolled out throughout the Gulf. And so Oman basically being the first mover here, I would expect that other GCC states are going to be watching closely and maybe think about replicating this idea. The other kind of new thing that's been going on in the tax space is this idea of a global minimum corporate tax. And so this is basically a 15% minimum tax meant for multinational firms that are, maybe domiciled somewhere and then, have a headquarters or a regional headquarters in other parts of the world. Um, and so what we're seeing is that Bahrain, Kuwait, and the UAE are adopting this 15% domestic minimum top-up tax. And that's in line with some movements from the G7 and sort of recommendations from the OECD. That's important when we think about foreign direct investment and the kind of companies that want to move to the Gulf and operate there. So, that's just a little bit of a picture of what's happening across the region. The risk is that what we're seeing in perhaps other places in the world, this risk of what we call stagflation, where you're getting higher inflation but lower GDP growth along with unemployment, is not really the same risk in the GCC. So these economies sort of react differently to the cycles that are happening in the global economy, and that's because they have different levers of control. So the GCC states still are very much, of course, dependent on hydrocarbon revenues, as I said, but also in the way that governments spend money. So the project cycle award is really important as kind of a stimulant of economic activity within these countries. So as long as government spending cycles kind of, prime the pump, so to speak, and these governments also are able to more tightly control labor forces because of their very tight immigration policies. So unemployment numbers are a little bit easier to manipulate because people can leave when they lose their jobs or can be forced to leave.
You touched on it a little bit in your, I think, wonderful kind of tour of the horizon, the economic horizon across the Gulf. But I wanted to drill down a little bit more specifically on energy markets and the impact of the recent 12-day Israel-Iran war. How did they affect those? How significant, how sustained was the impact there? That was something I know people were very concerned about.
This is something we've been talking about really since October 7th, 2023. What some people call maybe a decoupling of regional conflict risk and oil price. But there is this phenomenon where oil prices have been pretty sanguine in terms of the actual physical contact or conflict that's happening in the region. Why is that happening? Well, a couple of reasons, mostly because oil markets have been very well supplied, and some of that is about non-OPEC growth, U.S. shale. It's also because we're seeing markets basically looking at the risk and being very reactive and thinking if they're, until there is an absolute, block of the Strait of Hormuz or there's some, real, detriment to transit, they're kind of going to shrug it off. And this is different than, say, 20, 30 years ago, the way that that maybe oil was more concentrated or people had less access to information. But the actual practice of trading is changed that somewhat. So oil prices are back to their kind of flat prices, hovering around $70 a barrel. That was the July 15th price. What happened in June is that we saw basically about a $7 per barrel kind of risk premium kind of going up and down. So trading was ranging between about $65 a barrel up to or in the $80 range. when Israel attacked Iran, and then settled back down in the 60s. The other weird thing about this very real conflict that is erupted in the region is that people are saying, it's not affecting the regional economies as we would expect, particularly in equity markets. There have been a couple of recent pieces in the Financial Times sort of championing, Israel as the strongest economy in the region and the most resilient economy in the region. And basically what's happened is that the Israeli stock market, since the direct attacks between Israel and Iran, has recovered about 80% of its losses. And it's so, on an annual basis, looks like a very, very strong performer. And, that shows you that there's a lot of confidence right now at the moment in this ceasefire. But markets can react quickly, both the kind of oil markets and what we think of as commodity market trading, but also in equity markets. So, I think it's a little bit early to say like, oh, everything's great. The other thing that Israel has benefited from is that they have been able to, through their central bank, really manage their currency, and the shekel has really appreciated against the dollar, and so it is also kind of noted as a strong performer within the region. But that's a lot, I think, due to just very strong central bank management, and also the fact that Israel issues a lot of bonds, it issues a lot of debt, and there are plenty of international investors who are very happy to support Israel politically or as an investment motivation that helps the government in a period of real crisis. So I just think it would be a mistake to look at the regional economy and particularly the Israeli economy and say everything's fine. Everything's not fine. This is a small economy under tremendous pressure, particularly its labor market. So many workers are called in as reservists. We've seen a real flattening of economic activity, of course, in the West Bank and no economic activity happening in Gaza. So it doesn't mean that it's all okay.
Not a fundamental change in investor perception of risk to your mind. This sort of temporary factors at work here.
That's right. Very reactive. So, I mean, what does this mean? I think, the next question is, we've got a well-supplied market. We've got more and more non-OPEC supply. And Christoph Ruhl has made this argument that we're also more efficient in our use of oil, which is meaning that we're more efficient but less vulnerable to these spikes. And so what does that mean in the longer term? So if you're an exporter, certainly what we're seeing from Gulf exporters and OPEC led by Saudi Arabia is this is an opportunity for competition for market share. And so we can talk a little bit about the unwinding of OPEC cuts if you want to, but generally this is a market that is incredibly well supplied, more and more coming on board as OPEC unwinds some of the cuts from 2 years ago, 3 years ago. And, there's kind of mixed debate also on, where oil demand is going in the next year. OPEC has been meeting very recently in Vienna and has given this quite optimistic forecast for where oil demand is going. That's not where the IEA sees it or where we see many sort of bank analysts seeing oil demand.
But not the first time OPEC has been pretty rosy about those sort of things.
That's their business, right? So they certainly tend to see not just a short-term boost in demand, but they see that for a longer stretch of time as well.
Karen, as you mentioned yourself, the better part of the last 2 years has been a period of kind of continuous conflict. Israel has been carrying out military operations in Gaza and the West Bank and Syria and Lebanon, now also Iran this past month. There's been the closure of the Red Sea by the Houthis. I was wondering if you could get into kind of how the Gulf economies have been trying to adapt to this threat environment, this heightened chronic threat environment, and is there more work to be done on that front?
Yeah, so there's a little bit of debate, right? When we think about the way that the GCC states engage with Iran and, what their sort of strategic interests are and how they navigate their foreign policy choices vis-a-vis Iran and the rest of the region. And so I would be really careful. I don't see particularly between Saudi Arabia and Iran, that there is détente. I would call it rapprochement, right? It's an opening of communication channels, which has been very, very important and very useful, particularly between the kingdom and Iran. But it doesn't mean that there's a lack of appreciation for Iran's behavior or its capacities, and that is most clearly illustrated by Iran's attack directly on the Al Udeid air base in Qatar. So, I think that movement was essentially a big scare and a big revelation that Iran sort of crossed a threshold. They've done it before, of course. We've seen attacks from the Houthis, which have received support from Iran into Abu Dhabi. And direct attacks, of course, in 2019 in Saudi Aramco facilities in Abqaiq and Khurais, along with other attacks that happened on the East-West pipeline in Saudi Arabia in 2019. So it's not like it hasn't happened before, but I think in this context, that direct attack was chilling because when you see these videos of missiles flying over the Gulf skyline in Doha, videos of people running through the malls, this is not in line with the economic visions of any of the Gulf states. They want to be open economies. They rely on foreign labor. They need foreign investment. They want to develop tourism, sports, and different sectors that require really a safe environment in a sense that anyone can come and be part of these communities. And that really doesn't work when we see these kind of direct attacks. So what does that leave in terms of future risk? I think the big scare or the certainly the vulnerability has always been about the oil and gas facilities, and also the closing of the Strait of Hormuz. And so if this escalates again, and I do believe that this conflict is not resolved, it is not over, that one of the kind of key vulnerability sites would be some of the major Aramco refineries that sit on the Persian Gulf, including Aramco facilities, the refinery at Ras Tanura, pipelines, and we might see the use of softer targets or the attack on softer targets, and I think that might be something that Iran would be willing to do. But we're not there at this moment right now. The ceasefire is in effect. The U.S. Trump administration continues to say it is interested in negotiations with Iran. We can talk about what that would look like and how durable we could expect it to be. But I think from a Gulf state perspective, we're still very much in a sense of heightened risk and a sense of really needing to continue to communicate with Iran with the expectation that Iran is a country in some sort of transition. We don't know what that transition is yet, but it cannot stay the same. The government will have to be reactive to this changed environment, to the military effectiveness that Israel has shown, and really they were unable to respond. So both from a domestic standpoint, how do you regain legitimacy after that kind of show of force against you? And then how do you sort of reconcile that within politics and leadership and your foreign policy stance? It can't stay the same. It either has to be more aggressive or it has to have a massive about face, which within the current kind of political leadership, I think would be very difficult.
Taking for granted everything you just said about, for example, the Iranian retaliation on the U.S. airbase in Al Udeid, for the most part, the Gulf states managed to more or less insulate themselves during the Israel-Iran war. Can they do this again? I mean, was this kind of a model for going forward, trying to leverage their rapprochement with Iran and staying out of harm's way?
That's certainly the hope, right? But I don't know if it's possible. And Iran has said as much that, if particularly if their ability to export oil is threatened, they will threaten other people's ability to export oil. So this has been pretty much on the table. And then there's the troubling behavior of the Houthis, right? And so, the Houthis were quiet for a bit, and now have sort of reignited their attacks on ships going through the Bab el-Mandeb. And, this certainly is a big concern, particularly for Saudi Arabia. If we see an ending to the truce that the Saudis have had between the Houthis, there is this kind of fragile agreement between the United States and the Houthis, but the Houthis are seeing, lots of other targets as fair game. And there's the perennial question of, the kind of what is the lever of control that Iran has directly over Houthi behavior. Just in terms of like what that means in economic terms, war risk premiums for shipping through the Red Sea corridor are up this month. So in early June, the price of insurance on ships was about a third of a percent of the value of a ship. It's basically, the computation that jumped up to about 0.7% of the value of the ship. So more than doubling. So that is bad. Trade has been accommodated and moving around the Cape of Good Hope, and because energy prices and particularly fuel prices for shipping has been pretty flat, everybody's kind of like, oh, it's okay. We found workarounds, right? And it's not really been tremendously disruptive. But, that can change, and the Houthis have that lever of control. The biggest loser, in economic terms of, the threats to shipping through the Bab el-Mandeb and the Red Sea corridor has really been Egypt. Egypt is losing about $800 million a month in what would have been fees for using the Suez Canal that they would have been able to garner. So they have paid probably the heaviest economic price of Houthi threats in the canal, while kind of global trade and the countries which mostly used that route, i.e., China, have been, I would say, fairly insulated from that cost and from that risk.
So the Gulf countries are pursuing many ambitious long-term diversification and development programs. I think Saudi Arabia's Vision 2030 is probably one many people have heard of, but also investment in key areas like AI and tourism. So how vulnerable are these projects to kind of this chronic regional disorder and these sharp periods of conflict?
Yeah, I mean, as we said, there's this perception that, things are under control, that equity markets are okay, that these countries still have very good access to borrowing, certainly in the Gulf states. And that's true. But I think longer term, what we're seeing is this risk of fragmentation within the regional economy, which was true already between oil importers and exporters, and really the Gulf sort of taking off. But I think what the risk is that we'll see the Gulf states really wanting to insulate and sort of isolate themselves from risk in the region. So that has implications for the way that they're willing to extend support to other countries in the region, in the way that we have seen, some benefits from, for example, the Abraham Accords and engagement with Israel as an economic force in the region. All that becomes much more difficult. And certainly the threat, as we mentioned, to just kind of the safety atmosphere, in the sense of how, in the demographics of a large expatriate population, thinks about relocation to the Gulf, and how multinational companies think about having large headquarters and large staffs present in the region. All of that adds to a higher cost of doing business. Um, and harder to attract talent. And so, in Saudi Arabia, Vision 2030 is certainly about attracting foreign direct investment. 2025 has been disappointing in terms of FDI attraction relative to last year. And we certainly could say that this conflict has probably contributed to some of that difficulty in attracting FDI. There are lots of other reasons why it's challenging. But even for an economy which has been quite efficient and very good at attracting foreign direct investment, like in the Emirates, we're going to see, I think, at the very least, it slows down decision making. So firms that are thinking about relocations, building a bigger presence, whether that's in artificial intelligence or other sort of new technology ventures, they may think twice. And especially firms that have interest in both Israel and in the Gulf states, this creates a complication for them. So, for example, NVIDIA, the company that builds the chips, which are so important for the creation of the data centers that we hope to see in the Gulf, NVIDIA's largest sort of operation in the region is in Israel. It's not in the UAE. And so how the corporates choose to operate and have locations that might be complicated or challenged by conflict in the region is something certainly that we have to keep in mind.
Karen, it's unclear where things go from here on Iran, but it's possible to envision a range of scenarios. From the more optimistic, whereby the Israeli and US strikes serve as a catalyst for renewed talks and potentially a deal on Iran's nuclear program, to the more negative, like an Iranian race for the bomb or a period of internal destabilization. I know that's a pretty broad range, but what might those various scenarios mean for regional investment and broader economic activity?
Yeah, so I mean, I really see this as one of the major or the most important structural headwind to the regional economy. This, lack of resolution on, how the region feels and can deal with Iran. So it's a cloud of unfinished business, I would say, between Israel and Iran and the United States. So the nuclear program is damaged, but it is not disappeared. We don't really have clarity on Iran's intentions to rebuild and whether or not to weaponize its nuclear capacity. I think that question is more unclear now than it was before the war began. So that's a problem. Iran has also kicked out the IAEA inspection team, and any diplomatic solution is really useless without inspectors. So that has to be a key part of any sort of agreement. If the U.S. and Iran were to restart talks, that would be absolutely essential. I think what we're seeing, and I sort of alluded to this, is that Iran is at a bit of a crossroads. It is in a transition, whether it wants to be or not. It has to change. It has to think about how it wants to be in the region, how it wants to project power, how it deals with its military vulnerabilities. I mean, it's been given a lashing, you could say. That doesn't mean it's not dangerous. I think it's actually more dangerous now than it was before. So would Iran be willing to renounce its nuclear program, and including, of course, enrichment capacity? That, in the current political arrangement, seems very, very difficult. What would it ask for in exchange? What would be an enticement enough? And then within the kind of machinations of power within the government, you've got certainly religious authority, you've got the IRGC, which has significant political and financial capital. Can you pay those people off? Are people exiting with resources to, live another day and foment instability elsewhere in the region? Those are huge unknowns and real sources of vulnerability. We could see a retrenchment of defiance of regional militarism, and really a rewarding of the sort of hawkish positions within the government. That's a dangerous scenario, but I think a very plausible one. So, my short answer is I think the military action against Iran is not over, and that we will go through iterations of this until um, something really changes in the Iranian government's political calculations of how it deals with the outside, right? The neighborhood and the global community. So that's a dangerous and I think in some ways escalatory trajectory that we are on, despite seeing a ceasefire right now. So I unfortunately I think I have a rather pessimistic view on what happens next.
I think not alone in that assessment. We've also seen a lot of reporting recently about the potential, perhaps more immediate, of a reimposition of so-called snapback sanctions on Iran, with the troika of France, Germany, and the UK vowing to do that if no progress is made soon in the nuclear talks. How are Gulf states thinking about both that shorter-term risk as well as the longer-term risk of some of the scenarios that you just laid out in your comments? How are they kind of hedging and approaching that situation?
So, I mean, I think the first, strategy is this rapprochement, keep the lines of communication open, not to be seen as being two-faced with Iran. They want to have like real clarity in communications and in their own priorities. So that's important. You don't want to be seen as um, aiding and abetting whatever the U.S. and Israel may choose to do. That's a very, very difficult balance and position for the Gulf states to take because, of course, the relationship with the United States is very, very important, and we have lots of bases that are in the GCC region. So how they are used and parameters around how they're used is tricky. That'll be part of the conversation. But I think the GCC states want to be as transparent as possible to protect themselves. If they can be additive in facilitating negotiations in talks, as Oman has done for many years, that's one strategy, and it appears to work for Oman. Um, and then, they have to think about workarounds. So for Saudi Arabia, this means thinking about how much oil can you pass through the East-West pipeline to avoid the Strait of Hormuz. For the UAE, that's using the port of Fujairah instead of ports on the northern side of the Gulf. Um, it's thinking about, what other kind of defensive mechanisms do you want to have in place, and who you get those from, whether that's Patriot systems or really preparing for worst case scenarios. They'll be doing that too. Um, and, there are probably going to be some financial incentives around. So, we could get to a point, and this has been true, where the Gulf states are open in terms of conversations about how they would be willing to be economically engaged in a future Iran. We have seen very, very little evidence, of course, now because of the sanctions that Iran is under, of direct financial engagement with Iran. But keeping at least the conversation open and the door open is one protective measure, I would say.
Karen, earlier you said something very interesting about the Gulf governments contemplating the option of insulating themselves or cutting themselves off from the rest of the region as a way to protect their investments, protect their development path forward. I wonder to what degree they consider support for the reconstruction of, for example, Lebanon, Syria as part of that effort. Do they see their ability to, again, insulate themselves from the potential turmoil there should those countries collapse back into failed states?
Yeah. So I think, in some ways, this trend line is already established. What was true from 2011 to about 2018, and I wrote a book about this of Gulf economic statecraft, was this real interest in direct financial intervention in the surrounding region as a force for development, as a force for stability, sometimes with an ideological motivation. And that has really changed. There's this inward focus of the Gulf states and their own domestic economic agendas. And that has affected the way that they are willing to intervene financially in the stability of the region. Egypt has seen this very, very clearly. So, more and more the engagement with Egypt has been more on physical assets, the Ras Al Hekma deal, for example, the purchase of land instead of, making an FDI commitment or looking to buy Egyptian assets. They want something hard and secure and something that's useful for a long, long time. So I think the trend line is that the Gulf states are not really interested in rebuilding or remaking as a development actor the more fragile states within the region. So for Gaza, for Syria, for Lebanon, and especially aid and investment stability towards Iraq, have been pretty weak, and I don't think that's really going to change. I would frame this as sort of a new trend of global geoeconomics, right? Which is certainly focused on national energy security, national economic security, on deal making, and the Gulf states are very, very well aware of this. So it doesn't mean they won't make commitments or investments where there is a strong return or where there is a strong motivation to do so, but it won't be with the same largesse or with political motivations that we saw after the Arab Spring. So one example, if you want to look at Syria, which has been changing just minute by minute since December, is the Qatari commitment of about $7 billion into the Syrian electricity and power sector. And so this was seen as a real signal of Qatari support, but also of sort of consensus view among Qatar, Saudi Arabia, and the UAE to lend support to the new Syrian government and not to get into each other's way, which also was very much part of the 2011 to 2018 period of Gulf financial intervention. So what that agreement has basically committed, it's a Qatari company which is owned by a prominent Syrian Qatari business person called UCC Holding, in partnership with another power company called Power International, and a couple of Turkish companies. They basically agreed to build 4 new power plants. 3 of them are combined cycle gas turbine power plants, and 1 is a solar powered plant. And the thing about building new power plants, it's going to take at least 3 years. So this is not a quick fix. It's also a business. These are built as build, own, operate models or build, operate, transfer models. So essentially, this company, instead of a state utility, is going to have the control over the amount of electricity that is generated and then essentially the price of that power to consumers. Um, the problem for Syria, and Syria has lots of problems right now, is that this would, once these 4 plants are completed, would only meet about half of the projected electricity demand in Syria. So $7 billion gets you halfway. And it's not even really halfway because it's one thing to generate the power, it's another thing to get it into someone's home. And one of the big challenges in Syria after, over a decade of war is that the transmission lines are in very, very bad repair. And in some places, they don't exist at all. They've been looted, they've been damaged. So that has to be rebuilt. And government figures have quoted the grid repair alone cost in Syria of about $5.5 billion. That's according to research by Mies. So that's nearly all of that $7 billion. So you're spending the $7 billion on the power plants, but you kind of need double the power plants, so another $7 billion, just to give a round estimate, plus another $5.5 billion for the repair and build out of transmission lines. So just meeting a basic thing a government should do, providing electricity to citizens, is still pretty far out of reach, even with this generous, you could say, Gulf commitment to Syria. But it's not a handout. This is a business, right? Generating electricity, selling power is going to be more expensive all over the world. And so it's one thing to, say we're going to have it and we're going to sell it. People have to be able to afford it and not just access it. So anyway, that's, I think, just a very good example of, what the Gulf states are willing to do on a return on investment kind of basis, and then how it's still limited from a development perspective of what a fragile country in the region actually needs.
I think that's a really effective example of the change in their approach, but also really just underscores, to your point, the scale of the need in Syria. If you're talking about 20 billion and you're only talking about energy generation and distribution, let alone all the other problems that Syria is facing, it really underscores that point. Karen, I wanted to shift gears a little bit. We've touched on a number of regional factors that play into kind of uncertainty in the current economic moment that we're in. But there is, of course, another region source of instability, which is closer to home here in Washington, which is namely the impact of Trump's on again, off again global tariff war, also some of the regulatory changes that we've seen quite recently in the energy space in the One Big Beautiful Bill. How is all of that affecting Gulf investment, perceptions around Gulf investment, and especially those planned Gulf investments in the U.S. in things like the energy infrastructure and data centers that were announced during Trump's trip earlier this spring to the region?
Yeah, this is a really interesting change in the U.S. sort of policy and regulatory environment. An interesting change meaning that it is totally volatile, right? And it's really sort of thrown a wrench into renewable energy investment cycles in the United States for any investor, but particularly for agreements which in some ways predated the Trump administration. So, for example, in the Biden administration, we had the PACE agreement, which was the Project to Accelerate Clean Energy Investment in the United States. That was an agreement between the United States and the United Arab Emirates, which was meant to invest in clean energy in the U.S. and in other places. But the largest investments committed were those within the United States. And for, sort of new things that were announced during the president's visit to the Gulf a couple of months ago. And so it basically creates a regulatory environment that is still very much uncertain, even after the passing of this legislation. So one thing that happened after the passing of the One Big Beautiful Bill was an executive order that the president put out just a day later, which was essentially creating a 45-day review that the Treasury Department is responsible for, essentially looking at renewable energy investment, particularly in solar in the United States, in a clause which is called the Safe Harbor Clause. So essentially this meant that investments that were going into building solar power plants in the United States, if they had already basically started work, or had started a financial commitment and begun the process of build out, would be considered safe harbor, and so they would not be subjected to kind of removal of subsidies and these other kind of making it more difficult now for solar projects to roll out, and wind pretty much decimated. So if any of the Gulf states had investments in those projects, now everybody is waiting. Is the safe harbor clause going to be more tightly controlled? Are there going to be some projects which are, not going to qualify for that? So that's a huge question mark, kind of, put over the whole sector. Some things are safe though. So anything that's in geothermal, that's in nuclear investment in the United States is certainly privileged by this administration. And, overall, we're seeing very much a kind of change in perspective on the way that this administration thinks about climate change and renewable technologies as mitigators of climate change. And so it takes a different view. And Secretary Chris Wright had an interesting op-ed that he published in The Economist this week, where he essentially says climate change is a side effect of progress, is his framing. And it's sort of a necessary evil in some ways. And so this is, of course, a very different way of thinking about the speed and the necessity of build out of renewable power generation, and how it might be encouraged or subsidized by the U.S. government, which essentially now it won't be so much. The things that this Trump administration is willing to subsidize or encourage are technologies like enhanced oil recovery, which is something the Gulf states and their national oil companies are very good at and very interested in partnering with U.S. oil firms. So we've seen some partnerships, for example, between ADNOC and Oxy on this technology. You could expect some of those projects, whether they're in the U.S. or elsewhere, to move forward. But other projects, particularly on green hydrogen, not supported, right? So that was a place where we saw Gulf State and Gulf NOC investment in the United States, and those projects are certainly going to face headwinds. So, here's, the short takeaway is it depends on the technology. So it's not that all renewables are out. It's that, how much government support will be enabled. What are the kind of technicalities in terms of, keeping some subsidies in place for the next year or so if projects have been started, which ones will qualify, which ones won't. And, what would it be like if you wanted to build a data center and create a nuclear power generation site, whether that's an SMR or reactivating an existing nuclear power plant that's been decommissioned? These are some of the ideas. Would those be welcome investments? Yes, I think generally so. The problem for any investor, including a Gulf Sovereign Fund investor, is that this administration now has about 3 years left. Building a nuclear power plant takes a really, really long time. So you're looking 2 administrations out, not just one. So coming to an investment decision in the current U.S. energy policy landscape is just more complicated than ever.
I know you don't have a crystal ball, but what do you see as the kind of longer term impact on Gulf investment in the U.S. of those sort of trends? Is it just kind of create a wait and see attitude, or how does that affect things longer term?
So I think, it depends on the kind of investment. We're still going to see strong interest in U.S. debt, in U.S. equities, in U.S. real estate. Those are all still safe and good. In the energy landscape, it is a little different. And, the good news is the Gulf states and their sovereign entities are wide investors across the energy space. So they're into fossil fuels, they're into renewables, and they can do this in lots of other places, and they don't need the U.S. as an investment location to do so. It would be nice, and it would be nice for us, but they have a lot of other options, and they have a lot of other partners, particularly in their supply chains for like solar power, for example. I do have a visualization and data tracker at the Columbia Center on Global Energy Policy, tracking Gulf state vehicle investments in solar and wind power generation on a global scale. And so we see the build out of projects by companies like Masdar and Aqua Power, companies like Aqua, which are partially owned by Gulf Sovereign Fund, building out across Central Asia, East Asia, Sub-Saharan Africa. This is a big business. And with the ability to partner with Chinese suppliers, particularly for solar panels and wafers, they can keep doing this in other places and making money like we see in the Syria, small solar power plant, for example, building those out, owning them, operating them for many, many years to come. So that's a safe business to be in. One wouldn't argue that Syria is a better business environment than the United States, but on this small issue, how a solar power plant might be built, owned, and operated right now, maybe it is, which is a crazy thing to say.
Strange days.
Well, we're fast running out of time. We didn't really even get into the China question to the degree that we were hoping to. We'll have to get you back on to maybe just focus an entire episode on that. But just as your final thoughts, where do you see things going in the next half of 2025? What are you going to be watching closely?
Yeah, I mean, I think one thing to watch is the BRICS space, right? What is this relationship driven by China, but many other countries as well? When we think about this, and I don't like the term multipolar, but this is a period of fragmentation. And so we're going to see alternative ideas about how best to manage those national energy security, national economic security priorities, who to partner with. And just one little fact tidbit that I've been watching, if you look at GCC outward investment into the current BRICS members, so 11 countries, in 2003, before BRICS was a thing, GCC investment into those countries was about $920 million. In 2024, it was $42 billion. So that tells you something, right? More and more, what globalization means, the countries that are trading and investing with each other, are about South-South flows. It's developing countries, countries like the Gulf states, investing in that sphere. So that's a growing and important block, whether they're politically unified or not. They are a larger proportion of where economic growth is happening and where economic activity is happening. So the isolationism is, of course, coming more from the United States at this moment. But we have to be aware that there are alternative models, and there are countries that are growing and very happy to keep doing business with each other, with or without the United States. So that is the space that I think the Gulf states have an advantage as, purveyors and allocators of capital externally. That's a business they want to be in and they need to be in, right? So they need to find placements for these very, very large sovereign wealth funds. They need to generate returns, and they need to find ways to be useful, whether that's in the export of hydrocarbons, petrochemicals, and thinking about the longer term lifespan of what they make and build. And who they're going to be integrated with. So our whole global trade sort of institutional frameworks, as well as the actual geographies of these flows, is changing day by day right now, and the Gulf states will be, in many ways, the deciders of what those routes and connectivity looks like.
Well, that's all the time that we have for this week. Thank you, Karen, for joining us today.
Thank you so much.
And big thanks goes out to our listeners for tuning in, as well as our production team for all of their work on this week's episode.
To find MEI's latest coverage of energy and economic issues affecting the Middle East, please visit our website at www.mei.edu. You can also follow MEI on X, Instagram, Facebook, YouTube, and LinkedIn, and subscribe to our email newsletters for the latest analysis and information about upcoming events. I'm Alistair Taylor.
And I'm Matthew Czekaj. We hope you'll listen in again next week.